Money is often perceived as a straightforward topic of numbers, spreadsheets, and calculations. However, the true nature of money is far more intricate, existing at the intersection of finance and human behavior. Drawing inspiration from Morgan Housel's insightful book, The Psychology of Money, we delve into the psychological complexities that underpin our financial decisions and attitudes. Financial DNA. Our relationship with money is deeply influenced by our backgrounds and experiences. Each of us comes from different generations with unique parental influences, economic environments, and opportunities that shape our financial outlook. For example, those born in the 1970s witnessed significant growth in the stock market during their formative years, leading to a generally positive attitude towards investing. Conversely, individuals born in the 1950s experienced a stagnant market, fostering skepticism and a reluctance to invest. These experiences create a financial DNA that informs our decisions. Housel notes that people often justify their financial choices based on the information they have at the time and their personal histories. Even if their choices appear misguided to outsiders, they make sense within their unique narratives. As Housel aptly states, people do some crazy things with money, but no one is crazy. Understanding this perspective highlights that financial decisions are not just about knowledge, but are also influenced by personal experiences and worldviews. Compound Kings. Warren Buffett is often heralded as one of the greatest investors of all time, amassing a staggering net worth of $84.5 billion. Remarkably, $81.5 billion of that wealth was earned after he turned 60. Housel emphasizes that Buffett's success is attributed not just to his investment acumen, but to the power of compounding, which he began harnessing at the young age of 10. Consider this: if you invest $1,000 at an 8% interest rate, you earn $80 in the first year, but the following year, you earn interest not only on your initial investment, but also on the interest you accumulated. This snowball effect illustrates how compounding can exponentially grow wealth over time. If Buffett had adopted a more conventional lifestyle in his 20s, spending his early earnings on travel and luxury, his financial outcome would have been drastically different, highlighting the importance of early investment and the longevity of compounding. While Buffett may be the richest investor, others like Jim Simons have achieved higher average returns. Simons has compounded money at an astounding 66% annually since 1988, but, due to starting later, has a net worth significantly lower than Buffett's. Housel humorously speculates that if Simons had the same time frame as Buffett, his wealth could be unimaginably staggering $63 900 781 780 748 160 000. This serves as a reminder not to underestimate the immense power of time and compounding in wealth accumulation. Pessimism and money. Despite historical trends showing improvement over time, many of us harbor a bias toward pessimism, especially regarding money. This pessimism can be attributed to our heightened awareness of negative events, like stock market crashes or economic downturns, while the slow, steady progress of financial growth often goes unnoticed. The human tendency to focus on immediate losses rather than gradual gains can skew our perceptions and decision-making. It's important to remember that setbacks are a natural part of the investment journey, and maintaining an optimistic outlook can be beneficial. Viewing financial markets through the lens of long-term potential rather than short-term volatility allows us to stay focused on growth over time. Luck, risk, and tail events. The interplay of luck and risk significantly impacts our financial journeys. Housel uses the example of Bill Gates and Kent Evans to illustrate how chance can shape destinies. Gates had the extraordinary luck of attending a school with access to computers, which set him on the path to founding Microsoft. In contrast, Evans, equally talented, tragically lost his life in a mountaineering accident, highlighting the unpredictable nature of life. Housel likens luck and risk to the wind and waves affecting a sailboat's journey. While we can control certain aspects, many external factors remain beyond our influence. This understanding of success as a blend of talent, timing, and fortune fosters humility in our financial pursuits. The key to happiness. Many people equate wealth with happiness, believing that accumulating more money will lead to greater satisfaction. However, Housel argues that true happiness comes from the ability to do what you want, with whom you want, when you want, for as long as you want. This autonomy over one's time often outweighs the benefits of increased wealth. Studies consistently show that having control over one's life is a more reliable predictor of well-being than income or possessions. Accumulating wealth without valuing time can lead to a never-ending cycle of work and stress. Instead, prioritizing time management and life satisfaction can yield greater fulfillment. Tail events in investing. The concept of tail events, where a small number of occurrences drive most outcomes, is critical in investing. Housel shares the story of Heinz Berggruen, a successful art dealer who amassed a valuable collection over decades. While most of his acquisitions were of little value, a few notable pieces brought immense returns. This illustrates that in investing, a few successes can offset many failures. Amazon serves as a contemporary example. Despite numerous failed ventures, products like Amazon Prime and Amazon Web Services drove most of its growth. Jeff Bezos famously embraced failure as a necessary part of innovation, understanding that the path to success involves trial and error. True wealth versus being rich. It's crucial to differentiate between being rich and being wealthy. Richness is often tied to current income and visible possessions, while true wealth reflects the financial resources you have yet to utilize. Many people may appear wealthy based on their possessions, but they could be living beyond their means, relying on debt to sustain their lifestyle. Building wealth requires discipline and restraint. The ability to say no to immediate gratification such as flashy cars and luxury items contributes significantly to true wealth. Understanding that wealth is often hidden, cultivated through savings and investments rather than spending, helps shift our perspective on financial success. The real price of investing. Investing, much like climbing a mountain, comes with its own set of challenges and uncertainties. While the path to success may seem clear from afar, the reality is filled with obstacles that require reassessment and adaptation. Many investors mistakenly believe they can sidestep risks to achieve high returns, akin to stealing profits, rather than paying the necessary price of volatility and uncertainty. Housel emphasizes that successful investing requires accepting the emotional toll that market fluctuations bring. Just as you would recognize the cost of a new car, understanding the admission fee to participate in the stock market is essential. The price of investing is not just financial. It encompasses the emotional resilience needed to navigate its ups and downs. Hedonic treadmills, knowing when enough is enough. Finally, the concept of hedonic adaptation, or the hedonic treadmill, highlights the importance of knowing when enough is enough. This phenomenon occurs when individuals continuously move the goalpost of their desires, seeking more without ever feeling satisfied. The stories of ultra-wealthy figures like Bernie Madoff illustrate how the relentless pursuit of more can lead to unethical choices and unhappiness. Recognizing when you have enough, whether in terms of wealth, success, or personal achievements, can lead to a more fulfilling life. Avoiding the trap of constantly striving for more allows us to appreciate what we have and find true contentment. In summary, understanding the complex relationship between money, behavior, and human nature is crucial for achieving financial success and personal happiness. By acknowledging the influences of our backgrounds, embracing the power of compounding, and recognizing the roles of luck and risk, we can approach our financial decisions with greater wisdom and perspective. Ultimately, the journey to true wealth is about balancing financial growth with the pursuit of a fulfilling life.